In this video, we are going to talk about effective methods to trade synthetic indices. Synthetic indices are actually derived proprietorship markets that simulate the real-world markets. One characteristic across all of these derived assets is that they have high momentum and they tend to trade to every direction with high intensity. Merely looking at the charts, you can see that the market goes to every direction with force, with momentum. So it can be easy to trade, but it is always costly when you are in the wrong side and always lucrative when you are in the right side. So I personally have been trading this market for a while, and what have been some of my most effective strategy? What is my take about trading this market? How do I center my strategy of trading this market? All right, so one thing about trading these pairs is that since they have high momentum, strategies that deal with momentum tends to work better when trading them. So it could be strategies centered around moving average, which is a momentum indicator, or trend line, or market structure itself. As long as the strategy works well with momentum, you are good to go. So it's a good strategy centered around momentum and risk management, psychological management. You can trade these assets. You can trade dynamic support and resistance with price channel or moving averages or trend line, but the horizontal support and resistance, I personally see it as low probability here. You can take a look at your chart. Just take a look at your charts. You not likely see a lot of times where dynamic static support and resistance play out. So I talked about you trading with the momentum of the market, this market being a market that moves with high intensity and momentum. So yes, it moves with high intensity. It's a market of speed and direction. So how do you look at the momentum in this particular market? You look at the candles, you look at their sizes, you look at their direction. For example, if you look at this section, you see big bullish candles all trading upwards. Now, it is not going to reverse until it reverses. Look at this point, big bearish candles trading downwards. So basically, once you see a move like this, you know this is the momentum, and you want to avoid anything that will make you finding obvious levels for reversal, maybe with your static support and resistance. You want to avoid this in the market. Don't trade against the momentum. Don't trade against the big candles unless they show you sign of slowing down and reversing. If you actually trade against the momentum in this market, it could cost you a house, a car, or even a yacht. It's very expensive to be wrong in this market. We have some pairs that are actually cheap to trade here, but overall the market is not like Forex that will hang in the section and turn around. This market is mostly on the move. So talking about gauging the momentum and trading with the trend, one simple strategy you can employ is adding RSI to find confluence in your setup. So even if you are a smart money trader, you are a trend line trader, you trade breakout, you trade this, you trade that, RSI can be very effective in trading this volatility index market. You can go on and research the formula of RSI, but basically what RSI does is it measures the strength, the relative strength between bullish and bearish candles over a period that you set it to. So like you can see, my RSI right here is period 14 and my time frame here is 1 hour. So what's actually happening right now with RSI is that it is measuring the average of the last 14 candles. So it's telling me the strength of the last 14 candles. So if my market is going down, RSI should point down to validate the bearish strength. If my market is going up, RSI should also move up to validate the bullish trend. So basically, RSI and price should move to one direction if your trend is trending with strength. So RSI is simply strength of price. I don't use RSI with the concept of above 70 is oversold, overbought, then I have to sell the market, or below 30 is oversold. I don't use it that way. I just use the RSI to gauge the strength of price movement. Now, since this market is a market with momentum, speed, and direction, let me give you an illustration. So think of a car, a moving car that wants to turn. So how is it going to do it? Moving from point A to point B, and then it wants to reverse back to this point. This car moving to this direction is going to slow down at a point for it to be able to reverse. That's how it's done. So that's the work of your RSI here. Let me add one more illustration. If you throw up a ball and let's say you video it like with a camera that can capture object in slow motion, you will notice that after throwing up the ball, hitting a high, it's going to slow down before reversal. So basically, this is what I do with RSI. I try to spot weakness in price movement before reversal occurs. So if I have price moving this way and RSI moving this way, it simply means RSI is not supporting this bullish trend. In this case, this trend is weak. The strength of this trend is weak. It means this bullish movement is diluted with too many bearish candles. So that signifies weakness inside of price. So RSI is going to pass that information to me. Now let's go into our chart and try to practicalize what I'm saying here. So we look for a trending market, and before reversal occur, we try to spot some RSI clues. Now, basically, this is called divergence in trading. So when RSI and price moves to different direction. Now, look at this point I just marked, and then look at what RSI is showing in the same section from here to here. Now, what do you see? This point, same section here. What do you see? Now, if you look at this, you see price trending downwards, creating lower lows. But what is RSI doing? RSI is telling you price is holding on strong, like the price has strength. So the price is falling down, but the strength is sustaining a specific level and even slightly rising. So this is what we call divergence. RSI pointing to different direction and price moving to different direction. Now the ultimate direction of price is always the direction of RSI. Price is likely going to correct itself to the direction of its strength, which is the RSI. Now, how do you inculcate this trading these synthetic indices? And once you spot a section like this in your synthetic indices, what you want to do is you measure break of trend. So you want to throw in something like a trend line, or if you are good with market structure, you can simply do that. So you throw in something like a trend line into this section, or you go for your market structure. Let me use market structure in this particular case scenario. Now this is my previous high. Marked this high here. Now basically your bearish market structure is going to do like this: create a lower high. So if we take out a previous high, this simply means a higher high, and your bearish structure is supposed to create a lower high. So this is high probability that when market reverses from creating this higher high, we might not take out this low. So this is change of trend. This might signify change of trend, just market trading above this previous high. So coming back to this section, you see market doing exactly this. Market slightly trading above my previous high. Market slightly trading above my previous high, and at the same time trading above my moving average. Yeah, so this has been validated as a change of structure in a different method of analysis. I just switched to a higher time frame, and you can also see the same thing. So if you are doing a trend line, you're going to do something like breakout. You're going to trade something like breakout in this particular section. So linking these two highs here. Yeah, exactly. So we have this market trading above my trend line, coming back for a retest, or you can catch it just from the breakout, or you catch it from the retest. And then look at the move. After the retest, we have this explosive move to the upside, or if you caught this one, yes, this is also cool. But trading with RSI and trying to spot divergence in the market, you will be able to see price exhibiting strength or weakness before changing direction, before changing trend. Let me look for another RSI divergence example. And yeah, so we have a very nice example here. This section, price is creating higher highs, but the relative strength of price is decreasing. So you can see this. So if you see RSI setup like this in this volatility market, what you want to do is to watch for break of trend, either through your trend line, depends on which strategy you are trading. If you are trading your trend line, you wait for break of trend. If you are trading with basic market structure, you wait for break of major structural levels. In this case, we have this particular section here as my low, and you see my trend line. So this actually is confluence, price taking out my major low or breaking my trend line. And what happens, price come back here to form something like a double top. So this is for pattern traders here. So you see this price forming a double top, but the bottom line here is confluence with RSI. So before a change of trend, RSI should be able to show you price slowing down here. So you could see from this particular movement that price had no momentum going up. So it's going to get to a point and it's going to break down. So once price exhibits weakness, what you want to do is to join the new momentum of the market, even though people have not seen it. So yes, look at this divergence playing out here. Price came back to create this double top after breaking the structure, retraced to the upside, and look at the impulsive move to the downside. You might have traded this move from this point to this point, and that's thousands of points in these synthetic indices. So you can go on and backtest, look for divergence in your chart between your RSI, look for price slowing down in a trend. In a bearish trend, it's going to be the opposite. The first illustration was bearish reversing to bullish, and this one was bullish reversing to bearish. So you will likely spot price playing out all of these patterns. RSI telling you price is getting weak in a bullish trend, or RSI telling you price is getting strong in a bearish trend. So now that you have learned a high probability strategy, go on and backtest this, see how you can apply it to your toolbox of trading strategies. And do not consider the information in this context as financial advice, but they are given to you for educational purpose to improve your trading skill. If you like this content, leave a footprint of encouragement by clicking the like button and subscribe to this channel. Feel free to share this video with someone who you feel this video might help. Thank you and see you in the next video.